After topping global currency rankings this year, analysts are predicting tough times ahead for the Sri Lankan rupee. As the government eases import restrictions and debt repayments loom, the rupee is expected to weaken to 350 rupees by the end of December, down from its today, June 1st price of 287 rupees per $1, according to Standard Chartered plc and BMI. The currency's 25% gain this year has seen it capture the best spot returns globally, supported by rising tourist arrivals and inflows into the bond market. Sri Lanka's economy is slowly emerging from its worst crisis in more than 7 decades, anchored by the International Monetary Fund's $3 billion bailout that helped it regain investor confidence. As the government moves to loosen import controls and secure a debt restructuring deal, the rupee may come under pressure once more and set course for new lows. First Capital Holdings plc head of research Dimantha Matthew stated, "We expect the rupee to depreciate once imports normalize with the relaxation of restrictions and demand picks up. As the economy strengthens in the second half of the year, the rupee will be extremely volatile." The government plans to lift import controls on 100 items by the start of June, Finance State Minister Shehan Semasingh said last week. The number of items with import restrictions has already been reduced to 1,000 from a peak of 3,000, he said. The rupee may trade at 280 rupees to 320 rupees per dollar this quarter before weakening to as low as 405 rupees per dollar in the second half of the year, according to First Capital. That would surpass its record low 370 rupees per dollar it reached in 2022. Dollar inflows have also allowed the central bank to replenish its foreign exchange reserves, which climbed to a 15-month high in March. Upcoming external debt repayments, which we believe could start around the fourth quarter, alongside the need to build up reserves, will exert downside pressure on the rupee once again in the coming months, said BMI head of Asia country risk Raphael Mock.